3 statements, 1 system. Most people learn the income statement, the statement of financial position, and the cash flow statement as separate documents. But if you treat them as separate, you will misread them. And you will miss the errors hiding in the joins. In this episode, we map exactly how every line in one statement ties to a line in another, and we work through a numerical example that makes the articulation concrete. Let us start with the governing standard. IAS 1 requires a complete set of financial statements to include the statement of profit or loss and other comprehensive income, the statement of financial position, the statement of changes in equity, and the statement of cash flows under IAS 7. These are not independent outputs. IAS 1, paragraph 10, explicitly groups them as a single complete set because the numbers in each are derived from the same underlying transactions. The linkages are not optional and not approximate, they are arithmetically exact. The first and most important linkage is profit into equity. Profit for the period from the income statement flows directly into retained earnings inside equity on the statement of financial position. This is the articulation point that makes double entry self-consistent across reporting periods. When you close the books, revenue and expense accounts reset to 0. Their net, profit or loss, is transferred to retained earnings. Dividends then reduce retained earnings, but dividends never touch the income statement. That distinction matters enormously. Other comprehensive income complicates this slightly. IAS 1, paragraph 81A gives entities a choice: present one combined statement of profit or loss and OCI, or present 2 separate statements. Either way, OCI items, things like revaluation surpluses under IAS 16, remeasurements of defined benefit obligations under IAS 19, and fair value movements on equity instruments designated at FVOCI under IFRS 9, bypass profit for the period and go directly to other components of equity. So retained earnings receives only the profit or loss line, not the full OCI amount. Mixing these up is one of the most common errors in practice. Now let us run a clean numerical example. Imagine Northgate Manufacturing Limited for the year ended 31st December. Revenue is 2 million. Cost of sales is 1.2 million. Operating expenses are 300,000 and interest expense is 50,000. That gives profit before tax of 450,000. Tax at 27% is approximately 122,000, leaving profit for the year of 328,000. There is also an OCI item, a revaluation surplus on property of 80,000 net of tax. Total comprehensive income is therefore 408,000. Now the equity bridge. Opening retained earnings were 600,000. Profit for the year adds 328,000. Dividends declared and paid during the year were 100,000. And remember, these are never on the income statement. They hit equity directly. Closing retained earnings are therefore 828,000. The revaluation surplus moves from 0 to 80,000 in its own equity reserve. Total equity increases by 308,000 net of dividends, which ties to the movement on the SOFP. If these numbers do not agree, there is an error in the ledger. The third linkage is between profit and operating cash flow under IAS 7. The indirect method, which is by far the most common in practice, starts with profit before tax and adjusts for non-cash items and working capital movements. Depreciation is added back because it reduced profit but required no cash outflow. An increase in trade receivables is deducted because revenue was recognized, but cash has not yet arrived. An increase in trade payables is added back because costs were recognized, but cash has not yet left. This is why a rapidly growing, profitable business can simultaneously be cash flow negative. The working capital investment consumes cash before collections catch up. Here is the cash flow for Northgate. Profit before tax is 450,000. We add back depreciation of 90,000. Trade receivables increased by 120,000. That is a cash outflow, so we deduct it. Trade payables increased by 40,000. A cash inflow, so we add it. Net cash from operations before tax is 460,000. Tax paid of 110,000 gives net operating cash flow of 350,000. Capital expenditure was 200,000 and dividends paid were 100,000, leaving a net increase in cash of 50,000. That 50,000 ties directly to the movement in cash on the closing SOFP. Notice what the cash flow statement reveals that the income statement hides. Northgate made 328,000 of profit after tax, but generated only 350,000 of operating cash. That gap is almost entirely the 120,000 receivables build-up. Then 200,000 went out for capital expenditure, which does not touch the income statement at all. Only the resulting depreciation charge will appear there in future periods. The Capex replaces cash with a non-current asset on the SOFP. This is precisely the linkage between investing activities and asset movements that reviewers and auditors should always cross-check. There are several common errors worth flagging explicitly. First, double counting OCI in retained earnings. Remember, OCI goes to its own reserve. Second, including dividends as an expense in the income statement. Dividends are an appropriation of profit, not a component of it per IAS 1. Third, reconciling the wrong profit figure in the cash flow. IAS 7 paragraph 18 says, start with profit before tax, not profit after tax. Tax paid is shown separately as an operating cash flow under paragraph 35. Fourth, forgetting that non-cash investing transactions, like a right-of-use asset recognized under IFRS 16, do not appear in the cash flow statement at all, but do appear on the SOFP. The ultimate cross-check is the SOFP itself. Every movement in every balance sheet line should be explainable by one of the other three statements or a note. Trade receivables moved. Check the cash flow. Property, plant and equipment moved. Check additions per investing activities, disposals per the note, and depreciation per operating activities. Retained earnings moved. Check profit from the income statement and dividends from the changes in equity. If you cannot explain a movement, either there is a misclassification, an error in the ledger, or a disclosure is missing. This systematic linkage is the foundation of both a sound financial statements review and an effective audit approach. Bring it all together. The three financial statements are one interconnected system. Profit for the period lands in retained earnings. Dividends reduce retained earnings directly. OCI flows to separate equity reserves. The cash flow statement reconciles profit to cash by stripping out accruals and non-cash charges, and the closing SOFP must reflect all of those movements arithmetically. Understanding these linkages is not just exam technique. It is the lens through which you evaluate whether a set of accounts tells a coherent and complete story.